Are we live? Let's see. Let me check my feed. And we are live. Welcome back to Capital Cosm, guys. Today, we've got a lot going on. We've got a big sell-off occurring. Luckily, we've got Patrick and Kevin from North Star Bat Charts to walk us through some of those things that they've been seeing, what they think of the overall markets at the moment. And yeah, let me just go ahead and I think we're good. Cool. So Patrick, I'll let you kick it off. What are you seeing out there? What's your take on the market crash at the moment? This market sell-off, this crash, this crisis, destruction
Yes.
everywhere. Hope that's not a little too sensational for you guys.
Well, all those words are valid, but you got to attach timeframes to all those words. Any vocabulary that's used anywhere in, even in real life, we do it without realizing it. But especially in the chart trading world or in the trading world, you got to attach this because a crisis one day could just be a blip in a still a ongoing bull era in anything, right? So look, I'm going to prove a point here. So I'm going to start setting up on the smallest of time frames. Well, a small one. Here's the 4 hour chart, the Nasdaq. Always check the time frame, guys. Log scale. So from peak, I didn't know this was the peak there, but from peak to where we are now, it's down 10%. So that happened since goodness, July 24th. So what, over a week about? So over a week, the Nasdaq has lost 10%. What I'm going to go through the evidence with you guys. So here, what it's also lost was the 12 period moving average, so 12 times 4 hours, the 36 period moving average, a def cross, a rising trend line, lost the cloud. It's lost. So when I would see this, this is a stage 4 decline, right? So I have a top here on the 4 hour chart. So swing traders, scalpers, not swing traders, but day traders, scalpers, well, maybe not scalpers, but day traders, they look at the 4 hour chart. So this essentially is an uptrend that failed, backtest, backtest the 36 period moving average, backtest this congestion area, this wall, and down it went. So that's a 4 hour chart. But let's put in context. Now I'm going to put on the daily. There was enough damage on the 4 hour chart for the daily to also look bad. So below the 12-day moving average, below the 36-day moving average, below a def cross, it's also looking bad on the daily. So now there's enough damage that even the daily right now is starting to build a new downtrend, guys. And until it closes back above the 12 period or this possible rising trend line, descending trend line, you're in a correction mode, right? I'll zoom out weekly. Okay, here it gets interesting. The weekly, guys, whoops, there's no remove drawings. Right now, there's no clear breakdown by any means. Well, you lost the 12 period moving average, but you're still above the 36 period moving average. So when that happens, is you've lost shorter term momentum, but you're still above this weekly defined longer term momentum. So that's how much damage has happened. This does not happen often for the Nasdaq since its last crazy run there that started in 2022 off the bottom. One time it did it, 2 times it did it below that short term moving average, and now it's doing it for a third time. Will this be the top? We'll know in hindsight. But me and Kevin, we have techniques there that we use at North Star Bat Charts to assess probabilities of whether this or not is a more meaningful top. But right now, you stay clear until this resolves. Eventually, there will be some type of line here. I'm going to draw a squiggly line, a path here. Let's say a bullish scenario for this would be this. Something like that there. That could happen. I don't know if it's going to happen like that. We don't know. Okay, and I'll just do a small tangent. Once you realize, and I try to repeat this often, once you realize that you're in a correction, you have two choices to make. Either you hang on and you hope that it resolves upwards, that the higher time frames, the upwards momentum resolves it upwards, or you could step aside, wait for that shorter term correction that you've correctly identified. You wait for it to resolve, because just in case this doesn't resolve upwards and it does this, right? You could avoid all that. There's no reason to hang on when there's a correction happening, because that correction could just end up being the top. Well, all tops always start with a short-term price correction. They all do, but not all short-term price corrections are tops. So keep that in mind. And here's the monthly. There's still, look at the monthly. You cannot say, I know there's an indicator of pain at the bottom there. That's definitely more detail we could go into, but just on the price chart, there's nothing that broke down yet. Nothing. It's still above the 12-month moving average. It's still above the 3-year moving average, still above the cloud, et cetera, et cetera. There's no severe damage that's done yet. And that's my rant, my opening rant, guys. Right now, the weekly is starting to falter. It's in limbo land, but it hasn't yet cascaded on the higher time frame.
Yeah. So do you hold that same sentiment there, Kevin? And if there's anything else you'd like to add, go ahead.
Yeah, sure, Danny. I want to take that a stage further and try and answer whether this is, in fact, a something that's going to sort of turn into a more major issue for us. And I agree with everything Pat said there. And zooming out at times like this is very important. And one of the things that's going to tell us whether this is the top that Pat just mentioned is things like this chart here, the 10-year yield minus the 2-year yield, the yield curve inversion, which we've spoken about before, Danny. I've put a tweet out and increased the risk to medium from low to medium. So what I'm saying is that the risk of a major market event in the coming 1 to 3 months has increased to medium. We are not in the high risk category yet, but we have a medium likelihood of a high impact market event. Why do I say that? Because we've broken out or are in the process of breaking out from the consolidation pattern that's been taking place on this yield curve inversion. And history tells us that when this starts to interact with the red line there, with the zero line, we start to get into a period of heightened risk. Now, it's not an instantaneous event. It's not a case that as soon as you touch that red line, the stock markets collapse and all hell breaks loose. It can take several months, can take many months actually, but it's an estimation. It's one piece of evidence that we use to give us a little bit more confidence that something bad is coming this way. It's not a precise tool that tells us whether it's going to be next week or next month. It just is an indication that at some point in the not too distant future, we're going to be facing a high likelihood of a major market event. Now, when you combine that with charts like the ones that Patrick's shown, these are the weekly charts for the stock market. So I've got the SPX chart here, which is breaking down below weekly support, as Pat said. But my major concern won't really come until we break back below the apex of this rising bearish triangle and below the previous highs, so below the 4,800 region. So as Pat said, we're in a short-term time frame defined correction consolidation at the moment until or unless we break below 4,800. If that level is crossed and we pass through that red circle there, then we've got a much higher likelihood of a major top forming here and some major issues developing. Same thing for the Nasdaq. The Nasdaq is currently in a bearish rising wedge. It didn't break out of the top of it like SPX did. So Nasdaq is in a bearish rising wedge, and it's in the process of breaking down from that through the region that I've marked A. A is the first area of concern for me. And then area B is the more major area of concern because that is the horizontal pivot line, support, resistance, previous highs. Breaking below B opens up significantly lower targets. Breaking below B whilst the yield curve uninverts also opens up an environment where we could be looking at something much more serious.
Sorry, but before you move on there, that rising trend line there, if you tighten it up, could the Nasdaq have done a false breakout out of that wedge, the top line there, and you put on the closes
that certainly is a possibility, and I've shown that chart in both forms. So on the line chart, it does look a little bit like a false breakout. In fact, it is a false breakout at the moment. So a false breakout, and Pat, thanks for pointing that out actually, because the opposite happened, if you remember, those that follow me, with the 10-year yield. And when the 10-year yield had a false breakdown, it enabled me to say that false breakdowns from from bullish patterns very often result in a rapid and violent upside move. And of course, we know what happened with the 10-year yield. It had a rapid, violent upside move. Well, the opposite is the case here. This is a bearish rising pattern with a false breakout to the upside. It's now proven to be a false breakout on the line chart. And that increases the odds of a violent and rapid descent. It doesn't tell us with certainty that we're going to see a violent, rapid descent and a bear market that takes us down 50%, for example, but it just increases the probability of that being the case. So that's just evidence that we park to one side and take account of. This is another chart that I wanted to point out because Nvidia is a $3 trillion company and is one of those companies that have been holding up the stock market, is holding up Nasdaq. And if Nvidia proves to have a false breakout by getting a weekly close back below that black line, then that's another false breakout in a bearish rising pattern. And if we then break below the red no problems above here line, as we did before, and as we did before here, no problems above here, break below, fell 50%. No problems above here, break below, it fell, I don't know, more than 50%, fell from 35 down to 12, so fell much more than 50%. So the downside on this from $110 or so where we are now could be somewhere around $30. So you can imagine what that's likely to do with in terms of the rest of the stock market. There are a whole load of other indicators, and the most important one for me and Pat actually at North Star Bad Charts is the gold to SPX ratio, because if the gold to SPX ratio breaks out whilst this event unfolds, then it confirms for us that capital rotation is taking place. And we've been speaking about capital rotation for a number of years now, in fact, because this 0.5 line, this red line, is critical for us when it breaks above, if and when the ratio breaks above that, with these other events taking place as well, as has happened previously, historically, in the 1970s and in the early 2000s, then that is an indication of full-scale capital rotation. And something, Danny, just to point out, I'll stop sharing my screen here because, well, in fact, I'll just, before I stop sharing my screen, I'll zoom in. Something to point out, if you're looking at the gold price chart today and noticing that gold is going down like that, okay, we've got gold down $16 or more than 0.5%. Look at the gold to SPX ratio and look what it's doing. Mm-hmm. The gold to SPX ratio is rising. It's far more important in terms of where we go next, that gold to SPX ratio. So if the ratio goes up whilst the stock markets are correcting, it's showing relative strength for gold. And that is the first building block that we had in the early 2000s, the 1970s, was relative strength for gold as stock markets fall. If stock markets continue to fall, it's highly likely that gold will gather and gain strength. And as the stock markets eventually begin to recover, that is the period when precious metals massively outperform. So if the stock, say the SPX falls 50%, gold might drop 10, 15, 20% initially, and then begin to recover strongly. Now, the SPX could well take 5 years to get back to where it was, just as it did in the past, more 10 years. The entire period of stock markets going nowhere in the past has been 10 to 15 years when these events take place. So we could be looking at a situation where the stock market goes nowhere for many, many years. Well, goes nowhere. It takes all those years to get back to where it came from. So whilst the stock market is recovering and might rise by 100%, that's when gold rises 200%, 300%, 400%, 500%. It's a question of outperformance, and that's where the gold to SPX ratio comes in, and that's why it's so critically important. It's all about those capital flows and capital rotation.
Yeah, so you could have a scenario where both gold and the S&P falls, but how long until gold decouples from that? It has been decoupling because it's falling at a lesser acceleration versus the broader market. But when would gold, silver, commodities, when would they kind of start moving up?
Pat?
Move up while the SPX goes down, or just moving up?
So diverging from the point where they're just falling at a lesser pace.
Yes.
When's the point when they actually just kind of become a trade where you can actually make money on, as opposed to?
Well, they have. That's it. They have been. So gold has been in a bull run since June 2019, and then it went sideways, and then it continues to break out. So on its own chart merit, you could have been just the gold chart. You could have been playing that. Even silver, its breakout in July of 2020. It's still sideways, doing higher lows, now higher highs with it closing, having that breach above a $28-29 wall. So they're both those trades. They're in uptrends, right? They're above their 3-year moving average, above their 1-year moving average. They're in uptrends. Now, when to have gold and silver's more meaningful runs, the strongest moves in the shortest amount of time, those happen when gold is outperforming SPX. So it's sucking away those capital flows or getting more capital flows than the SPX. And that's when you get better gains. And especially the people playing the miners, etc., they track. You could overlay a lot of the miners, and their chart looks like the gold versus SPX. The weak ones, the stronger ones look like gold versus inflation. So that's when the gold and silver really go up, and they'll go up together. They'll go up, like Kevin said. Gold will bottom before the SPX bottoms in a true bear market. Let's say 2001 type of move down or 2008 type of move down in the U.S. stocks. Gold will probably decouple, so they'll go down initially, maybe, I don't know, half of the way down, or a third, or 3 months before the U.S. equities bottom, or 6 months before the U.S. equities bottom. That's when gold will start going up. But then it will go up, SPX down, but then SPX and gold will go up together. But gold will go up on the recovery phase. Gold will go up faster than SPX until SPX breaks out and resumes its bull era. So for SPX to do that, it would have to, so let's say 2001, it goes down. 2007, it matches its 2001 highs. It fails, goes down. 2009, it bottoms. And in 2012, it breaks out of its, above its 2007 peak, above its 2000 peak. And that's exactly when gold topped. Then you would look at the gold versus SPX ratio. It would break down. And that's all she wrote. So there's no, goodness, it's crazy to say, but even if gold is up at 2,400, 2,500, there's no golden precious metals bull era, not bull run, bull era. We're not even there yet. So imagine this. Now, wherever gold is at 2,400, and then let's say this is the top. Let's do a simulation. SPX starts tumbling down, and it really enters a bear market, and the chart that Kevin showed you starts turning upwards. Then that's the starting point for the gold bull era. We're starting at 2,400. That's it. We're starting at that, wherever level. We're not starting at 1,100. And then we could go on a 5-year, 10-year bull run. It depends how long we're able to outperform the SPX. And that's where you get what Kevin loves to say there. Gold's going to double and double again and double again. And that's when these 5-digit gold prices don't look that crazy anymore, right? They've destroyed so much of purchasing power to save U.S. equities that, goodness, they're just adding zeros, guys. Look, did you go? Who goes to the restaurant here? The price is bonkers. Like, I forget where I ate. I went to eat somewhere, and I said, man, this is like, wow, there was like nothing under $20 on the menu for a regular, like, it used to be $5 a burger. Now, look, I don't want to do that speech again, but you know how it is now. And that's just where we are in society right now. Destruction of purchasing power is the name of the game there. And remember, gold will sniff out ahead of time that destruction of purchasing power, right? Gold, look, inflation rate has been plummeting. Gold's going up. People, inflation rate is what drives gold. No, gold actually bottoms when inflation rate breaks down from a rising inflation rate channel, breaks down. That's when gold bottoms. And gold's front running. If ever it smells that there will be another wave of purchasing power destruction, it front runs that. And it very well may be when inflation starts turning back up and breaking out again, that could be the top for gold. It could very well be. And everybody's saying, oh, inflation is going up, gold's going to keep going up. Well, the market's smart, and often it loves pricing that stuff way ahead of mom and pop retail traders there. That was my rant. Was that enough?
What about the miners, though? When do the miners begin tracing the price action of gold and silver? It seems like the miners have been acting more as growth stocks or low small cap stocks as opposed to anything related to gold and silver. What do you think about the miners?
Miners are pretty terrible. There's not a lot great that you can say about the miners at the moment. I'll show you a chart, and I'll just partly answer that previous question as well around how long before gold decouples. So let me just see if I can get the screen sharing to switch on for a moment. Okay, here we go. So this is the gold chart and this is the gold roadmap. Okay, and I'd previously projected the move to $2,000 and then the long consolidation and then the breakout move. Now, the breakout move from the back end of last year has taken us, in fact, from around about $1,600 to $2,400 and in fact to $2,500. So we had a $900 rise in the dollar price of gold without gold even breaking out versus the S&P. Okay, $900, and we don't even have the full capital rotation yet. So this roadmap sort of indicated resistance between 25.35 and 26.60. Well, we've reached 25.22, which is close enough, I think, to that target, given that the target is just measured using some, these lines on the chart can be about $50 thick. So, let me just readjust that and get that back to where it was a second ago. There we go.
$210,000 gold. Is that what I
saw? So what I'm saying is that from this point, it's quite possible that gold comes back to test the support level.
What are you, Kevin? What, you're going to give people heart attacks? Gold can do that.
If the markets sell off, right? I mean, let's get something straight here. That gold does not have to test the support level. It does not have to come back down to 2000 or 2100. It doesn't have to do that. But in terms of probabilities, if the market sells off heavily from here, it is entirely possible that gold will start to sell off and get caught up in this, as it sometimes does, but not always. So the longer term outlook, if stock markets continue to show weakness and move into a bear market, is for gold to have a correction that will, in my view, not fall below the 2000 to 2100 area. Silver, of course, is vulnerable to a larger percentage decline, but then the capital rotation takes over, and then the real gold bull era, which hasn't even started yet, becomes becomes the case. That becomes the environment that we're in. In terms of the miners, well, all you have to do is pull up a ratio chart of, and I'll do this live for you. This is ASA, which is a gold and silver mining index that has 50 years of history versus gold. Okay, and this will tell you whether you should be invested in the miners or in gold. Now, I've shown this chart quite a few times, and it does seem to upset people, I'm afraid, Danny. But I'm afraid reality and truth doesn't always land well with people. But if you go back to the 1970s, I'm afraid the miners have lost. Well, almost at one time, nearly 100% versus gold. I should mention at this point, GDX and ASA are a perfect match. Okay, so if you overlay the GDX onto the ASA chart, it's just that GDX doesn't have as much price history, but I can assure you that GDX follows ASA to a T. So comparing ASA to gold is a very valid scientific thing to do. So what I'm saying here is that there is absolutely no point at all holding gold miners if they're not outperforming gold. There are times when the gold miners outperform gold, like this time here, where I've put this little ellipse highlighted between about 2000 and 2003, or in fact, it peaked in 2002. So there's a roughly 2-year period there where the miners outperformed gold. Now, I know people are going to be saying, well, some miners outperform gold by much more than that. Well, yes, some do. You can pick out exceptions to the rule, but this as a chart is the average of all of the gold and silver miners contained within that index. And as I said, GDX follows it very closely. There's another period there between 1980 and sort of 1984 where the miners outperformed gold. So what you're looking for in this chart is a breakout, Danny. If it doesn't break out, what the hell are you doing owning gold and silver mining stocks? You're putting yourself automatically in a losing position. You're putting the odds against yourself. I know everybody gets attracted by the idea of making 1,000% and some obscure mining company is going to go up like a meme stock. Okay, those events do happen, but they are outliers. And what are you doing here? Are you trying to catch an outlying event, or are you playing the probabilities like a good poker player does, and putting yourself in a winning position where you're more likely to be a winner than a loser because the house wins most of the time? So put yourself on the side of the house The house knows what's going on, and that's exactly the same as saying this chart knows what's going on. This is like looking behind, the workings of a casino and knowing what's going on and knowing what's most likely to come up, black or red. Until we cross this line here, you're on a loser owning gold and silver miners. So my rant, for what it's worth, is that do not touch gold and silver miners until they actually break out, because every little upside move is met with rejection, upside move, rejection, upside move, rejection. And over 50 years, the miners have lost to gold. It's as simple
How
as
dare
that.
you? How dare you? Blasphemy.
Well,
But
I want to get the audience's take on this. If
Yes.
you
Stop the share.
yeah, if you're still bullish on the miners, if you still own miners, if you're if you don't necessarily agree with Kevin's take here, give me a 1 in the chat. If you don't agree with Kevin's take, give me a 2 in the chat if you do agree. Really interested to see what everyone else here has to say. Let's shift over to energy. The oil market's getting hit as well. There does seem to be a bit of this contagion effect going on where everything in the market is getting hit. So let's go ahead and take it to oil. Who wants to take it? Kevin, Patrick.
I can pull up I'll pull up the chart for Brent if you like, and
Yes.
we'll
While Kevin sets that up, I'll tell you one thing about those miners. I'll throw them a bone. If you planned, I know most people, they don't want to hold miners a long time there. People, they just want to play like the crazy move. But if you adjust it for dividends, it looks much less worse. Oh no, I shouldn't say that, right? I always correct my kids. It doesn't look as bad if you click on adjust there. But that means if somebody would have reinvested all the dividends they would have ever had from playing the miners historically, that chart, the performance of the miners versus gold over long periods of time is not as bad as showcased there. So that is in the favor of the miners, the dividends that they might pay out.
Okay, so this is a chart for Brent. Okay, and we are still contained below this breakout line. Okay, we've broken out above major resistance back here in 2021. We broke out above $80 and we spiked all the way up to somewhere close to 140 there. So we hit resistance, we've been rejected, we're back down testing the support line. So in terms of, and as Pat always says, it's all about time frame. Okay, what is your time frame here? If you're talking about the big picture, then we're building for a potential big move to the upside. But if you're talking about what's happening in the next few days, weeks, and months, then there's nothing longer term bullish in terms of weeks and months on this chart until we break out above that developing resistance line, that red line there. So we get a convincing close above somewhere, I suppose, $83, $84, preferably $85 and towards 90, then you can start talking about much higher upside targets. And the higher upside targets you can see illustrated on this chart here. People perhaps find it a little bit hard to believe that crude oil at $200 to $300 is coming in the next 5 to 8 years maybe, but the chart suggests that is a high probability outcome after the current correction and consolidation is complete. So we've got more correction and consolidation to work our way through. I wouldn't be bullish on oil until it breaks above that resistance line. This is the beauty of charts. It puts everything in context. You can see, people sometimes ask me, how do, these lines that you put on the charts are just squiggly lines, they're just random. Well, I'm afraid they're not. They are being observed by traders and by algorithms. So, a lot of the trading is done through probably AI these days. I've got absolutely no idea, but mathematics comes into this. It clearly comes into it because the trading algorithms and the human traders are able to identify when resistance is being reached. And when resistance is reached, sell-off occurs. And if the sell-off goes below a support line, then the sell-off becomes steeper and deeper. So in terms of fundamentals and narratives, well, you can attach whatever fundamental or narrative you like to why oil isn't breaking to the upside. I don't particularly care, but I can put a line on this chart. If I'd been back here in, when was it, 2014, 15, that line would have been important to me. And the moment we got that monthly close below that line, I would have said to anybody asking, okay, we're now broken below support. There's nothing bullish about this. Step aside, wait for the whole thing to resolve because we've broken, very important support. Same thing would happen here if price fell back below that black line, would be below an important support level, and goodness knows how low it would go if that was to happen. So observing where support and resistance lines is the very first building block for any trader, really. I was going to say chart trader there, but it should be any trader. If you're trading just on fundamentals alone and totally ignoring and not taking note of where support and resistance is, then you're crazy in my view. So, technical chart analysis has to be first and foremost in what certainly is in my mind. But I don't know about the people watching this podcast. Hopefully they agree, and hopefully they can understand why technical support levels are important.
It's like, Kevin, you don't have to hope for an uptrend if the price is above an inclining moving average. It's reality. You're an uptrend. You're above an inclining 12-period moving average. But people sometimes with fundamentals, they hope the fundamentals gets priced in by the market, right? I saw a tweet today, or whatever you call it now, and this person wrote, I exited all my uranium. It's in a stage 4 decline. I don't know what time frame he's looking at. I can't.
I've seen plenty of those.
He says it's in a stage 4 decline, irrelevant of what the fundamentals are, right? Because you see, you could have a stage 4 decline, the fundamentals don't change, or your perception of what the fundamentals are don't change, right? Because you're always looking at a subset of information somebody's giving you, but there's always another subset of information that you're not even aware of. And then the price starts going sideways, loses momentum, starts declining, but the metrics or the information you're relying your decision making on hasn't changed. So you don't exit because you have no reason to exit because the fundamentals hasn't changed, but the price is changing. How do you work through that? Like I would have a conflict in my head, and I'm like, being a logical person, I would say, and pragmatic, I say, well, hold on, something's wrong. It's like your wife comes home late at night. She says she's not visiting anybody. She smells like perfume and all that. Look, she says she's not cheating on you, but she is. You gotta respect the price, man. The evidence first and foremost. How do I come up with these analogies?
No, she was just hanging out with one of her friends who happened to have some perfume on her from her boyfriend that she rubbed on herself, and then she gave her a hug, and so that perfume rubbed off on her. So that's what happened, Patrick.
Okay. Well, there you go. So a logical, fundamental explanation why the price is going down, but the price is still going down. So you could try to trick yourself in convincing yourself that the fundamentals are in your favor. But if the price is going down, that means you're not looking at the good fundamentals, if fundamentals mattered anyways, right? If you really think fundamentals matter and the price is not in agreement, then you're not looking at the good fundamentals. You're missing something, right?
Classic example, Bitcoin has great fundamentals, and there's a lot of discussion around, Bitcoin going to 100,000 or whatever, but the fundamentals haven't changed since it was 71,000 whatever it was, and it's currently trading at 63,000. So it's fallen by $8,000, whatever it is. The fundamentals haven't changed, but the price, depending on what time frame you're trading, of course. But if you're trading on a weekly time frame or a daily time frame, then that matters. The fundamentals haven't changed, but the price has fallen 10%. So trade the chart, not the fundamentals, because the chart, or not the fundamentals that you think you know, because the chart knows all of the fundamentals. The fundamentals are what builds the chart. The narrative and the fundamentals that are known by every single market participant is what's building the chart in front of your eyes. So the chart is reflecting the truth. The narrative and the fundamentals that you think you understand, you may or may not be in possession of every single fact that drives the price of Bitcoin or whatever it is.
Yeah. I want to get into uranium in a second, but before we do that, I want to call out to the audience to drop any questions you guys might have to Patrick and Kevin. We'll try and answer as many as we can. No promises that we can get to all of them, but drop your questions in the chat. Really interested to get to see what you guys think about this sell-off. Patrick, Kevin, let's go ahead and shift over to uranium. Who wants to take uranium? Uranium is a wasteland, like you put it when we were off camera. But what are your thoughts on the current state of uranium?
Let me take it up there. So, yeah, Intel. Look at that, man. Intel down 27. But hey, look, I just want to do a tangent. I don't want to avoid the question, Danny. But look at Intel. Here's the monthly chart, and look at that breakdown, def cross, huge rally up. but just failed, right? It wasn't able to, recapture. I don't know where the wall is
It's doing
here.
a Wile E. Coyote, Pat. Splat.
Just jumped off, right? It
Yeah,
like even
off the
here,
cliff.
Nvidia there. Where's my Nvidia chart? Nvidia, look how stretched at the bottom pane, guys, is how stretched you are above the distance from the 3-year moving average or 36-month moving average. Look where Nvidia was right there. It doesn't mean the price can't keep going up. Sometimes you're super stretched and you just slow down. But you slow down, but you're still going up, and the moving average catches up. But this is what's important: is once you're stretched, but then you break down the momentum and retest. That's when you're vulnerable for more sideways move or a crash down. Here, lost momentum, and look at that. It's stretched. So that's step one, being stretched historically. Step two is actually a breakdown in momentum there. So it's really, really, really close there to losing important momentum. And that doesn't mean it's going down to zero, but it means that the upwards distancing from the moving average has halted, right? So this is in Nvidia there. It's very vulnerable right now for, in hindsight, we'll say, oh yeah, that was a top. I'm not saying this is a top. I'm not saying to short. You never short anything that's above an inclining moving average. That's like suicide. But what you can do is exit longs that you bought much lower, right? And if it's hard for you to exit longs that you didn't buy that much lower, it's because you bought a little bit too late in the rally. So anybody who bought here on the pull flag or down here, this is a profit taking zone. We're in it. I've identified that like a long time ago there. So look, measured moves, a whole bunch of stuff. So that's technically Nvidia is in profit taking zone. It's in correction zone. Doesn't mean it's the end of the world. It could be, but we'll only know in hindsight.
But Jim Cramer
So
said
yeah.
that it wasn't the end of the world today. So that means that it is.
Oh goodness, it's over. Poor Jim. Like,
When people come out on social media and say make black and white statements, it isn't over. It is over. It's the end of the world. It isn't the end of the world. That really should raise a red flag in anybody who's, I don't know what it is, some kind of human reaction that people like black or white. It is going to be doing, but when you're talking about the future, when you're trying to predict the future, anybody that says this is going to happen, that is going to happen, that isn't going to happen, they clearly do not understand the strange art and science of forecasting the future, because forecasting the future is never ever about black and white statements. It just isn't. It can't be. If you try and pretend that it is, you're a charlatan, you're a snake oil salesman. I don't care what Jim Cramer said or anybody else. If they're coming out with statements like that, I'm going to call them out on it, because it is complete and utter BS.
Yeah, that's the
yes.
meteorologist in you, Kevin.
Yeah,
no certainties, only probabilities.
34 years of forecasting, scientifically and technically, predicting the future. One thing that's taught me in any realm of forecasting and prediction is that it's a game of probabilities. It's a game of being real about it and assessing all the possible outcomes and assigning a likelihood to all of those possible outcomes. And if you're not prepared to be honest with your audience and say, there's a 60% chance of that happening, there's a 30% chance of that happening, and a 10% chance of that happening. If you're not prepared to be honest about it because you're scared that they're going to say, oh, well, so anything can happen then, can't it? You've covered it. I'm sorry, but that's not how science works. That is not how forecasting works. Forecasting has to be about likelihoods and probabilities, and anybody that tries to pretend otherwise is just deluded.
That's a harsh reality, but
yeah.
it's true. And we're saying that so people follow on the channel or you're on Twitter and this guy's saying, mortgage your house, buy this thing, and it has to go up or it's a guaranteed thing. Look, no, like, if a guaranteed thing would be a real thing, poker players would go all in. Well, with pocket aces and think they'd win all the time, but they only win, pre-flop, 86% of the time. So it's a probabilities game.
Yeah, I mean everything has a margin of error. I'm a data scientist by trade. All of our models have a margin of error. There's nothing certain about this, this stuff. And even within that margin of error, you've got a certain amount of confidence, whether it be 95%
Yes.
confidence, 90% confident, whatever it is. But nothing is ever 100% confident. So
Exactly. And when you
point.
make a forecast, Danny, you monitor that forecast as it develops because it has to stay within those confidence level, within those parameters. If reality that you're measuring wanders outside of your expectations by even a small amount, you then need to reassess your entire model, your entire forecast, because it's going in a direction that your model wasn't expecting. The model that you put forward is always the model that is most likely. Whenever I post charts on social media, what I'm posting is the most likely outcome. When I posted the gold forecast back in 2019, I was forecasting what I considered to be the most likely outcome based on weight of evidence. It turned out to work, as we now know, it turned out to work extremely well, and the chart followed the forecast very well. But had it started to wander outside of those parameters, I would have kept going back and readjusting and readjusting and readjusting. And that's what you have to do when you're forecasting. You have to take all the latest data into account. If you don't do that and you just stick with your previous prediction, regardless, like some people do, oh, gold is going to $1,000, gold's going to $1,000, and they keep saying that, hoping that one day it will. You're you're deluded. And if you're going to keep saying gold is going to $10,000 next year and it doesn't happen, and then the next year you say it's going to $10,000, well, eventually you'll be right because of purchasing power destruction. You will one day be right, but so is a stop clock, so there you go.
Yeah. Yeah. Patrick's chomping at the bit to crush this Cameco chart. Go ahead, Patrick.
All right.
Yeah. Sorry.
Well, yeah. So this is pretty much what happened with Cameco. So beautiful breakout above the 1 year, 3 year moving average, above the horizontal necklines. It's got it all, right? The beauty of closing above a horizontal neckline is that you're guaranteeing you have a new high, right? If ever here I'm closing above horizontal breakout line, that means the previous high is always going to be lower. So you have higher lows leading up to it, building up momentum, higher high, uptrend, right? And then after that, whether it fails or not, that's secondary, but with the evidence we had at that time, that was an uptrend. So beautiful run for Cameco. Sideways move here. So it lost momentum here. So distance from 3 year moving average, very important. It lost some acute one, but here's a longer steep one, back test. And that was the giving you warning signs. It doesn't mean it's going back down to zero, guys, when you lose momentum. It doesn't mean that it's over. It's just telling you that you're not in the optimal situation where you have higher chances of having a sustained move up, right? And a fun move up. When you have in a stock and it happens to be exploding away from the moving average, you feel great because day after day, like 5 days, 4 days out of 5, it's green. You feel great, right? That's when you're in a true bull run, right? It keeps going up and up and up. Month after month, it's green. More green months than red months. That's what you have. But when you lose momentum, now it's a chop. Half of the candle is going to be green, half of them are going to be red. But again, if you're in a chop, don't be biased, because if you have a position here, let's say you have a position, I bought Cameco, I led up into this, I'm in the correction, but because I'm still holding Cameco, my subconscious is going to try to trick me in believing there's higher probabilities that it resolve upwards. It might, you're still above an inclining 3 year, but it could have also stayed longer sideways. It could have also went down, right? That could have been the top, right? You just don't, in hindsight, that thing resolved upwards. So up sideways move, whether you decide to hold or not. Those who hodled, well, they got their wish. It broke upwards. But now it's like it's reaching these pull flags. It's distance from moving average here, guys. Just like I showed you on the NVIDIA chart, high watermarks. But look at that. This is, look, when you start hitting distance from moving average resistance levels, high watermarks, it doesn't mean you go again like you go short, but you're in profit taking zone. But then once you get, I'm going to remove all my drawings there. Once you get a momentum breakdown like this last month, right? July, look, the close of July, 1 touch, 2 touch, 3 touch. That's it. And it's not that steep. The steeper the line, guys, the more I'm picking at data that's short term. Like it's almost like if I would have a less steep line on the daily chart. I'm on the monthly steep line. It's important, but it's not as important as a less steep line. And that one's getting to be pretty long. It's a 4-year trend line, not that steep, right? It's not like I'm saying the momentum broke down here. You know, sometimes the momentum breaks here, but the price still manages to go up. Now it's a topish looking type of big pattern. It broke down, and guess what happened after? Here's the breakdown right here. When I broke down, I was still above the 12-month moving average, etc. And now it's just worsening. It just is, guys. Now we're building. It could be a flag. I don't know how big that flag is going to be, but I know that because this is a monthly candle chart, it's going to take many months for this to resolve. 1 month, 2 months, 3 months, 4. Like goodness, like before this resolves upwards, like imagine the 3-year moving average here. I'm just going to extend it for you guys there, just for visual. See, like here, 3-year moving average. So it could take, before this breaks out, it could be March of next year before this breaks out once again, right? And again, once you realize you're in a correction, you have to decide, do I want to hodl through it? But if that's the top and you hodl through it, then you're dead man walking, because now you've lost all that time, and you could have been cash, you could have been any other, like, pharmaceuticals, whatever's outperforming that. So it's tricky now, because now selling to strength on the monthly chart is evaporating, because now it's more weakness. So you're not selling to strength anymore. You're selling to weakness, right? So there's like 2 ways that you could sell, right? You could sell into strength, which is super hard to do because the price is going up. There's no red days. You don't feel any justification to sell, right? There's like, and the news is bullish and hurrah, hurrah. We're all like in our echo bubble. That's the hardest thing to do ever, unless that was your plan to do it. And then selling to weakness, well, it depends what your pain threshold is, right? Okay, there's a little weakness on the daily. The daily's failing. The weekly's failing. Like I showed you the first chart, the NASDAQ chart. Now, what do you do? Because if the monthly fails, it's possible that, it could cascade on the quarterly. It could be the bottom. Goodness, it's like, but it's good. Whatever you could say is, if you start failing on the monthly, it will take months for it to recuperate, right? It's going to take months. It's not going to, it could V-shape. That's rare, but it's going to take months, maybe a year for that thing to heal. So it's like, I don't know how to say it, guys. It's you can't hodl anything forever. And if somebody sells you that sales pitch, it's like, goodness, it's like they're not being truthful with you. Look, uranium had a great run in the 2000s, but it also had gold breaking out versus SPX. There's a whole bunch of elements that aren't in place right now. It's like super great what uranium did amidst gold not outperforming the US stocks. It was like bonkers what it did, right? Uranium was one of the few commodities. Well, no, there's a whole bunch of there, but it broke out versus SPX while gold didn't. Uranium broke out versus SPX. If I put the NASDAQ versus Cameco destroyed NASDAQ, right? It even held its ground versus NVIDIA, right? A lot of people saying, guys, how come you're not playing all that crypto stuff? Well, we're playing Cameco. We're doing great. Like we had, Cameco was like a lone horse, but now the ride is has been over for a little while there. We've been out since like January, a while back there, and we took a stab at it when we thought it'd continue back up, but that failed. So you just got to respect the price, step aside, and there will eventually be a great new opportunity in it. It's just when. So
there's a lot of pressure, Danny, from certain quarters to go sort of heavily back into uranium when it looked as though it might be turning a corner, but the technical chart evidence just was not strong enough. So, we held back from that and, prefer to wait for stronger chart evidence, which didn't materialize. So that was a big relief that we're not sort of heavily in the uranium sector. But it's also worth pointing out that a whole load of uranium stocks, and I could list, quite a lot of them, that didn't even enter a bull market. They didn't even break out. So there's a lot of uranium stocks that got left behind, whilst the likes of NextGen and for a while Mega Uranium and Energy Fuels and Prom and Cameco and others, they were breaking out into bull markets. But I would say, looking at my list of uranium stocks, there was a good probably 25% or maybe more of them that didn't even get out of the starting blocks.
Yeah.
So
yeah, totally. I mean, you read these comments about people who've been in uranium for 5, 6, 7, 8 years, and complaining about the fact that they haven't made any money off of it. It kind of boggles the mind. But then you mentioned your point, and it all makes sense. It's because they're not really, they're betting on the lottery ticket side of uranium, not
Well,
necessarily.
that's where ratio charts come in, Danny, because you have to compare each individual stock versus SPX versus the URA index, and preferably versus gold and other things. So you can do these ratio charts, and what you can do is pick out the outperformers. So you can narrow down the field from maybe 40 uranium stocks to 6, and those 6 are all outperforming S&P, outperforming gold, outperforming the URA index. Because if you're not outperforming the index that the stock comes from, you might as well just buy the URA ETF or the URNJ ETF or whatever Sprott, miners ETF. So if you're not beating the index, you might as well buy the index and just play it safer. It depends on your attitude to risk and money management and what suits your own trading style. But if you just want to have exposure in the sector, then you might as well be buying the ETF. But if you're going to buy individual stocks, like many people do, for goodness sake, make sure you're buying one that's broken out versus the index. And if you don't know how to do that and how to monitor it and how to chart it, then we're here to help, sort of thing.
Yeah, totally. We'll have the link down to North Star Bat Charts if you guys are interested in Kevin and Patrick's newsletter, not newsletter, but just stocks
Website.
Stock website. We'll have that link down below. Didn't mean to overcomplicate it there. Do you have time to answer questions, guys?
Yeah,
sure.
Cool. All right, so we've got a question. Let's see here. All right, you may have already answered this. It's from Freeze It. He says, overall, the miners ignore it all. So can the miners rise again?
Well, they're dead forever, Danny. They're not coming back. But yeah, of course they can, and it comes back to. I feel sorry for people who've got money sunk in the miners and watching it, bleed away. But treat it as a lesson, really. And it goes back to what I said about the uranium miners. Pick the miners that have relative strength. Don't try and be clever and pick some micro miner that hasn't even, or explorer that hasn't even started pulling, gold out of the ground yet. Because when this sort of event happens and there's a sell-off, those things go pretty close to zero pretty damn quick, and some of them actually cease to exist, and you lose everything. So do not sink large amounts of money into things like that. Always use risk and money management. Always set your profit limit and your stop loss. Have some kind of way of managing downside risk, so that if that stock were to fall by 50%, you would end up losing only 1% of your net asset value. That's an easy thing to do on all brokerage accounts. You can set your profit limit, you can set your stop loss, and you can sleep at night because you know that if that stock falls 50%, you will lose only 1% of your net asset value, 1% of your overall pot of money. If you're not doing that and you're losing sleep at night because your stocks are dropping 20, 30, 40%, then you have to have a serious rethink about how you're doing it. So yes, gold miners can and very probably will rise again and probably will outperform gold for a period of time during the next precious metals bull run. But my suspicion is that they won't outperform gold for very long, because historically they never have done. And also, by the way, if you look at GDX, the index, the gains for GDX from bottom to top during the last bull run in 2000 to 2011 were comparable, very similar to gold itself. Remember, gold went from $200, $250 up to roughly 2,000, so a 9x. Well, I think I think I'm right in saying, Pat might have a chart you can look at, wasn't. I think the GDX went up roughly the same amount, but in a more volatile fashion, and gave a lot of it back much more quickly. So don't fall into the trap of thinking miners are a way of getting rich. They are a way of they're a way of leveraging your gains for a short period of time during a precious metals bull run. And if you think differently to that, then you're expecting something to happen that is completely different to anything that's happened historically.
Yeah, and to just standard disclaimer, guys. Nothing in this video is financial advice. Always do your own research and due diligence. And but yeah, you do run the risk of essentially playing a lottery ticket with the miners. So
it's an exciting lottery ticket, and if you time it right and you know when to get in and when to exit and when not to be too clever, then you can do very, very well. Don't misunderstand me. There's very, very good money to be made in the miners, but you do need to know what you're doing
Yep.
to eliminate that risk and to maximize the gains at the same time.
So next question is from Pizza 603. He wants to know, do you think there will be another lower buying opportunity in a major pull down in gold before the quote unquote bull era, like in the GFC?
Pat, what do you think?
Well, the bull era has not started yet. So, will there be a new low? Well, like look at Kevin's charts there. The possible pullbacks, the magnet lines, the important resistance turns support. It likes to get retested eventually. But guys, look, I don't know what to say to you, but
I think the distance from moving average is the key there, Pat. Actually,
yes.
on the weekly time frame, I can pull up that chart. I don't know how much time we've got, Danny.
Well,
I've got as much time as you guys have, so we can
uh,
keep going until you guys
but
have to split.
But buying lows, guys, it's a crazy thing to do there. I know. It's like I like buying the dip, but goodness, it's you gotta be careful with that stuff, right? Because remember, the dip could just be the start of the bear market, right? You got to buy after a huge base. When the base breaks out, that's your low risk entry point, right? Anything after that, if ever there's a pullback, at least wait for the flag that the chart pattern that created the pullback, right? The bullish right falling wedge, etc. The pennant, the flag that pulled back all the way to the dip. At least wait for that to break out once again, and then
So,
that's a lower risk entry point.
that's the monthly. That's the gold roadmap I showed you earlier on. But if you focus on the bottom indicator here, I'll just expand it a little bit. This is the distance from 3-year moving average. So you can see how crazy high it went in 1980, but that's unrepresentative because, of course, gold was pegged prior to that in the earlier period of the 1970s. So there's a very rapid and unrepresentative rise there, a little bit like on the Bitcoin charts. When Bitcoin hit the scene, you got some crazy, crazy momentum. So I think we can disregard that peak and look at the more recent history, for example, through the precious metals bull peaks in 2011. So the distance from moving average target that you would call reasonable is kind of this zone here. So when that indicator gets up to around about 40 to 60% above the moving average, then on the longer term, you would expect some kind of much more significant pullback. If we look at the weekly chart, which is applicable to a slightly smaller time frame, you can see just how stretched we are or aren't on the distance from moving average indicator here as well. So that kind of peak there that we've just hit looks to have been a sort of a target area. It's not often we go above that on the weekly, and it's in the process, I think, of sort of trying to reset at the moment. But we haven't really broken down, I don't think, on the
Looks like a
momentum. Or perhaps
breakdown,
we
Kev.
have. Perhaps we have. Maybe it's very close, isn't it? There.
Well, yeah, it
You
broke
could
down
take,
there,
you could
but
take that back further. You could put that there, but that's
yes,
probably a bit too
exactly.
shallow. But something like that. There's a little bit of a breakdown
But
there, but something around that line there seems to be quite significant. Um, and also, you would look at whether the momentum is actually breaking out again at the moment, which is close to doing. So, at the moment, I'd say on the weekly time frame, we're not decisively broken down below that support line. We're not decisively broken out above that one. So the question still remains whether there's room for price to move up towards my higher targets up near sort of 27, 2800, or we start to, well, for want of a better phrase, capitulate a little bit here and see the price retracing all the way back down to that 2100 level. So to answer the guy's question, I think looking at price, you could draw a line here at, what is that? Let me just move that box out of the way. About 2300. So if price were to drop below 2300, then it opens up a much higher probability of coming down towards the sort of 2000, 2100 area. But at the moment, all it's doing is forming some sort of consolidation and even trying to break out on the weekly time frame. So if we get a weekly close there that's above 24.20, if it's convincingly above that, then it looks like a continuation move to the upside. So yeah, I've talked myself all the way around in circles there, haven't I? But what I would say is that his question was, are we likely to get a lower entry point? And at the moment, that probability is not really on deck at the moment until we get a clearer breakdown. If we get a clearer breakdown, then yes, there's a much better chance of getting an entry point closer
Right.
to that 2100 level. But long term, gold is in a bull market. So, what are we doing here? We're messing around between 2100 and 2400, which in the grand scheme of things is probably going to look a bit irrelevant in a few years' time.
And even that black line, Kevin, I'm looking at it. It doesn't quite make sense. Like that black line materializes, that means the daily chart is going to fail, the weekly chart is going to fail, and the monthly chart is going to fail. The daily is not even failing, for crying out loud. We're
No.
breaking out on the weekly, guys. Think about it. So there's no need. You got to go back to multi-time frame analysis before the doom scenarios where I could load up happen or present themselves. The shorter time frames will. That's what we do at NorthStarBatCharts.com. There, you'll get access. Like often on Twitter, you'll see our bigger picture charts, but you won't see these fine-tuned. When is the daily chart starting to roll over? When's the weekly chart rolling over? That's what's important, because the monthly and quarterly chart will never fail over if the smaller time frames don't fail over first, and the longer term uptrends will never resume upwards until the shorter term trends and the time frames start resolving upwards, right? So multi-time frame analysis is like a key function of all this, and it's from a probability wise to start looking at when is the pullback going to happen. It's kind of a little futile if most time frames are in uptrends. It's just, you got to have to start seeing some weakness before saying, okay, like Kevin said, the roadmaps he shows out, for him, they're the most probable ones. Well, it's the same thing. Why waste energy and time looking at a disaster scenario if it's not? It could be there, it's a possibility, but because the probabilities haven't shifted majorly in favor of that happening, then you got to just push that in the future, right? And it could be, we have the 2008 type of correction. It could be from much higher up. It could be, goodness, I don't know. Let's say we go to 4,000, and then you could correct 30% to 3,000 or whatever. Like, who knows when that's going to happen, right? So you got to let the chart do its thing.
The current pattern is, it's sandwiched us between 2,300 and 2,500. That's the range we're in, 23 to 25. There's very clear support and resistance. We're above rising moving averages on the daily time frame. We're above the daily Ichimoku cloud. This is the daily chart. Yes, we're hitting resistance. Yes, price is getting pushed back from that resistance level, but we're still within the 23 to 25 trading zone. We're just in a trading range at the moment. On the weekly time frame, we're well above the Ichimoku cloud. We're above the 36-week moving average. We're above the 12-week moving average. On the monthly chart, we're well above the 12-month moving average, well above the 36-month moving average, well above the Ichimoku cloud. So it's bullish on daily, weekly, and monthly timeframes. So there's no cause for concern or no suspicion of much lower prices for gold yet, until it starts to roll over, at least on that daily time frame.
Yeah. So my next question is from Chad Harding. He wants to know, if everything's going to drop, what is going to drop the least?
Well, ratio charts, right? Ratio charts. And
yeah, as long as that gold to SPX ratio holds level and continues to gain momentum, gold is going to drop less than SPX. Okay. As long as that ratio chart does not break down, there's no reason to think that precious metals are going to suffer more than the S&P. Silver is likely to suffer more than gold. Okay, that's something that tends to happen when precious metals pull back strongly. Gold is likely to hold its value on a relative basis relatively well. It might suffer a 10 or 20% correction to the S&P's much larger correction if we are entering that major correction period. There's nothing yet to say that is certain. We haven't broken down on the monthly time frame, as we were talking about earlier on. So there's no certainty about that yet. But if we're on the assumption that this is a market top taking place, and we're heading much lower, then I suspect gold will hold its value better than the stock market.
Okay. Next question is from Pizza603. He asks, would you rather be in cash, gold, or bonds until this market all falls apart?
Pat, your thoughts?
Well, look, to answer that question, you would have to look at the charts if you want precise, like which is an uptrend versus the other. But usually in these market crashes, it's a DXY strength that puts a strain on everything. So in 2001 and 2007, the DXY went up with the U.S. stocks, and then the U.S. stocks they crumbled as the U.S. dollar is like breaking everything in its path. And then you could hold on to that, the US dollar, until they destroy the US dollar or devaluate it to the point that they're able to resuscitate, the US equities, right? Lower interest rates and make it less attractive to hold US dollars versus other currencies, etc. Not financial advice, but that's practically what happens, when there's when you start seeing that there's not that many breakouts and there's not that many, sectors that are breaking out in the across a variety of sectors, cash is starting to get really interesting. Or by default, you should start being cash. Let's say you're not even thinking of cash as a position, but it is. But you can't allocate it because the Nvidia stretch and you're in profit taking zone and chemicals breaking down and there's a whole bunch of stuff not really giving you low risk opportunity. By default, your NAV risk is super low because you're not holding anything, right? You're cash. And that's not a bad place to be, right? It's not a bad place to be at all there. Defense wins the game.
Okay.
Yeah, sure. I mean, 10-year yields and government bond yields are dropping at the moment, and so government bonds, should be a pretty good bet. But it's not a market I tend to play. But the 10-year yield is dropping, so government bonds should be pretty good. But that and cash, there's technical chart evidence to. I mean, you have to ask yourself, what would you have wanted to do in 2007, 2008? What would you have wanted to do the last time the S&P fell 50%? Well, any kind of stocks are risky, whether it's tech stocks, any of the sectors in the S&P, although some are holding up pretty good at the moment, like pharmaceuticals, I think we've mentioned. But stocks are risky across the board. Cash is a position, like Pat said, and I don't see any problem at all with moving to cash, letting the dust settle, and then using the evidence to reallocate, protect your NAV. It's about NAV protection during a market event. Protect your NAV at all costs so that you live to benefit from the outcome. And if the outcome is that gold breaks out versus S&P, then you could very well double your money in the following 12, 18 months. You could quadruple your money. Last time this happened, as I said, gold doubled, then it doubled again, and then it doubled again. And then the S&P broke out versus gold, and then you rotate into the S&P and you see your money appreciate in the S&P. So that's the way I would play it. I'll like Pat said, observe the ratio charts. Ratio chart analysis is at the heart of knowing where to allocate, comparing one sector to another mathematically using a ratio chart, which is something we do all the time.
Great. Well, next question is from Golden Warrior. He says, is silver bottom somewhere around the $25 or $26 range?
Yeah, I think the silver arc that I've got, the chart that I issued way back in, I think it was 2020, 4 years ago. I think the support there is somewhere around $24, $25. It doesn't preclude an intra-month spike below that level. You could get a scary spike down to, I don't know, $20, $21, but it's where the month closes that matters. And as long as that silver roadmap, and those of you who might not have seen it, just go on my feed on X and you'll see my silver long range forecasts. And as long as that arc, that cup pattern holds, it's in fact the cup that silver's in is actually the handle on a cup that goes back much, much further. So it's a huge cup and handle pattern with $50 as its sort of neckline, or $50 as its sort of target area. So we're progressing towards $50 erratically, big pullbacks along the way. But over the last 4 years since I issued that forecast, nothing has happened to change that model. As you mentioned earlier, we have a model, we're following that model. Nothing has materially changed to make us rethink that. So despite these big pullbacks, silver is still on course to move towards its $50 target.
Okay. Next question from Aaron Kitching. He wants to know, if you had 100,000 pounds or dollars, let's say, cash right now, what would your strategy be over the next 12 months? Well, you got to subscribe to the website, but I'll let you go ahead and answer.
Subscribe to the website and we'll tell you. But NAV preservation, when an event is taking place, don't take unnecessary risks. I have my, as Pat does, we have our ideas about where this may be heading, and that would perhaps mean deploying that capital when we get confirmation of gold breaking out versus the S&P. The S&P is vulnerable, so I won't be touching the stock market at the moment. It's not an entry point for the stock market. If you got in, years ago or many months ago, then fine. But this, for me, isn't an entry point on any time frame for the stock market. We need to confirm that capital rotation between S&P and gold. If we can confirm that, by the way, the gold has already broken out versus the Dow Jones. Gold has broken out versus M2 money supply. Gold is right now in the process of breaking out versus CPI. So a lot of these pieces of the puzzle have already fallen into place. But that's why gold has moved from $1,600 to $2,400, because the evidence piece by piece is falling into place. Pretty much the last piece of evidence is gold versus the S&P. And it's because of companies probably like Nvidia and a relatively small number of big companies that have so far slowed down the ability of gold to break out versus the S&P. Take away those companies, and probably the gold would have broken out versus the S&P the same as it has done versus the Dow Jones.
Okay. Next question from Gypsy Tree. He wants to know, do you think the Fed has an emergency cut before the next meeting in September?
Well, it's funny how the
tell us
market.
your insider secrets, Patrick. Go ahead.
I have no insider secret. Look, when the Bank of Canada cut their rates there, I did a chart, and usually it's the Bank of Canada follows the Fed. It's like in Canada here, the US has a cold, we sneeze, or you guys sneeze, we have a cold, like whatever, right? We're kind of like, Americans that speak French here, practically there in Quebec there. It's like, I don't want to generalize, but so the Bank of Canada cutting and the US not cutting, it's like something was off, right? But you know what's going to force the Fed to cut? The market will force the Fed to cut, right? Because if ever the market starts tumbling, then they'll do whatever, their emergency rate cut. Maybe they were supposed to cut. Maybe the market wanted them to cut this one and didn't do it. And now they're having a little tantrum. The initial jobless claims, I'm looking at that like crazy, because when that starts trending upwards, the US jobless claims, I think it's one of the Fed's mandate that spooks them. And often there's rate cutting cycles when the initial claims start trending upwards. And I have like a neckline at 241,000 jobless claims. We're right down level. But if ever we start convincingly having closes above that 241K, alongside gold breaking out versus SPX, because the gold versus SPX chart looks a lot like the US jobless claims. When all that pieces come together, rate cut, and especially that the other central banks have already cut, it's like une question de temps there. Like it's a question of time there before they cut, right? But this cut is not going to be like, a healthy cut. It's going to be a cut, especially if all those other indicators are rolling over that. It's just more confirming that the downtrend is the top possibly, and a new downtrend can set in.
Pat made a very good point there. It's not a healthy cut, so not all rate cuts are born equal. And if you look back historically to see how rate cutting cycles affect the stock market, on more occasions than not, so well over 50% of occasions, and it's probably something like 75% of occasions, rate cutting cycles are not good for the stock market. Stock markets are very often not happy when rate cutting cycles begin. So what I'm saying here is don't expect a series of rate cuts to suddenly miraculously stop the S&P falling by 50%, because it's not proven to do that in the past.
All right. Well, I think that's all the questions we've got. Patrick, Kevin, anything else you guys want to talk about before we put this thing to a close?
Man, I think we've covered we went from covering the stock market crash, potential crash, to covering the entire scope of the tradable instruments, right? So
We didn't mention crypto, so that's one thing we didn't touch on. So if you want to know what's happening with crypto, take a look at our X feeds and the Bitcoin Doom Dome. It's a clickbait title, but it's the Bitcoin Doom Dome has been doing its thing for quite a long period of time now, and Bitcoin ain't doing anything until it busts out of the dome. If it busts out of the dome, great. It's just a resistance line like any other resistance line. So Bitcoin can go to 1,000, it can go to 1,000,000, but until it busts through that dome, then we are stuck.
All right. Well, if you guys are interested in checking out Kevin and Patrick's work, I have a link to their website down below in the description. So be sure to check it out. Click on that link if you want to see more of their work. Kevin, Patrick, thank you so much for coming on, guys. And if you guys enjoyed this content, give me a like, subscribe to the channel if you haven't already, and comment, go North Star, bat charts, go. Or just go Patrick, Kevin, whatever. I'll let you, it's to your discretion, guys. With that said, I'll let you, wallow your tears away, or, maybe something else. I don't know. Well, we've got an interesting weekend ahead of us, an interesting week coming up ahead of us. So we'll continue to monitor the situation. We appreciate your time watching this channel, and I will catch you in the next episode. Bye, y'all.
Cheers. Bye-bye.